Hey there, how you doing? Welcome back to the channel. Today we're just going to do a little stock update and just talk about a little bit what the stock market did today. Today was a Fed day. I guess nothing really new. Just, the usual kind of stuff. We're going to hold rates low forever. And the usual from the Fed. I guess we can say in this time, I guess Powell didn't spook the market, so the market didn't like sell off massively or anything like that. So I guess that was good. So we'll go through some of the charts and all that, but I just kind of wanted to talk about more generically is like, well, it's interesting, isn't it interesting that like there's focus on the Fed? I mean, if the thing that I want to look at is, why is there so much focus on the Fed? The entire stock market, the entire financial markets, stock market, bond market, everything, commodities, everything like is hyper focused on the Fed and what the Fed will do. And really they parse every word that the Fed says. And this goes back to Greenspan, and Greenspan was known as the maestro, and he used a lot of big words and was always pretty fancy and stuff, and this kind of made it him maybe more aloof and stuff like that. And so this would, I don't know, I think this made many in the market happy because they're like, oh, it makes it sound like, well, he's got it under control because he sounds smart, right? I think there's some element of that. But I think, a useful question to ask is, why is everyone paying so much attention to the Fed? And if you look at it from a practical matter, the simple answer is, of course, everyone pays attention to the Fed, because if they go and try to raise interest rates, that would increase the cost of capital in a period of time where it's just very obvious and clear to everyone involved in the stock markets, bond markets, in any way that, housing market, anything, that we could tolerate very little increase in rates. And so therefore, if the Fed was trying to hike rates, of course, this would be potentially really bad for the economy, different parts of the economy, but pretty much the whole darn thing, including all the markets, the bond market, the stock market, et cetera. Because at the end of the day, I think everyone, has that feeling that, yeah, this is all unsustainable. The debts that we have are not sustainable. And it's just, even if you don't know the detailed numbers, you don't really have to. You just sort of get that sense that, like, yeah, if interest rates went up even a little bit on the debt that the government had to pay, and we're at something like 27 trillion of debt, that, we couldn't afford to pay the interest payments on that. And things would just break down very fast, because when you have that much debt, the interest payments, I mean, we're already beyond the point where we can really make the interest payments. So if the rates went up and the government had to pay more for an interest on the money that they borrowed, it would just be a disaster. It would spiral out of control. So that's why I think there's this focus on the Fed. But what's very interesting, and I guess I'm gonna so I guess here what I'm going to do is cast a little shade on, some of the younger YouTube guys out there, in particular the Kevin dude. You guys know who he is. And he is just like, a buy the dip kind of a guy, and he makes these funny videos like, oh, buy the dip and all that. And he's, he covers live coverage of the Fed, meeting and all that. And he really focuses in on, what people are saying in the financial media, what the Fed is saying, all the things, and paying really close attention to it. Now, I certainly get the idea of, given the way things are, that of course you want to pay attention, because if you don't, and they start making some policy changes, it's really bad for your stock portfolio, right? But the thing that's lost on this person, in really all these other people, is that there's this illusion that, well, the Fed has it all under control. And if the Fed, because for example, I think he was going through this whole, what the Fed was saying and how they're talking about, they expect, this whole concept of, the Fed expects interest rates to be transitory and all this stuff. And it's like, okay, well, you're just buying what the Fed is saying. I mean, of course, what is the Fed going to say? The Fed is going to be like, of course, this inflation is transitory. The inflation numbers that you're seeing in the PCE and all that, like there's potentially some fairly high inflation numbers there. So what do you expect the Fed to say? Of course, they're going to say they're transitory because the Fed knows it can't go out there and raise interest rates. And the Fed also knows that it can't, it can't handle higher rates from the market pushing them up. And so it has to keep this illusion alive that, hey, there's no inflation, right? So that's the problem. See, if interest rates go up, there's an implication that there could be higher inflation in the future. And so this is really the essence of it. So the funny thing is that a lot of these people, and this is what CNBC, and all the financial networks, not just that one, they always just take at face value what the Fed says. But, I've been watching markets since the late 90s. And, it goes back to like the maestro Greenspan, the markets are a little frothy or irrational exuberance and all this stuff. But, time and time again, what you learn is if you've been through these really big cycles, the Fed doesn't really have that much control over it. When things turn south, there's very little that they can do. And right now, they're in a position where they really can't do anything. They're actually in a very big box. Now, the counter to that is people would say, well, look, you're being a bear, you're being a perma bear because you don't want to believe that things are actually fine, things are okay. But the thing is, the counter to that is you have to buy into all this. You have to buy into what the Fed is saying, hook, line, and sinker. If this inflation is not transitory, the consequence of that is pretty significant. I mean, the interest rates, if they go up and keep going up because people don't want to buy those bonds, and the Fed, remember, the Fed can come in and they can try to fix those interest rates, and they can go out there and say, hey, look, this is what we're going to do. We're going to do this interest rate targeting and basically try to control the interest rate at every point in the curve. They can do that, but there's no guarantee that they can be successful in doing that. One of the interesting things is I've watched all these guys in the George Gammons of the world, and you get really into the guts of what's going on underneath the Fed and the financial system, even the Van Meter guy and stuff. And it's really amazing. It's like there's a lot going on there, and it's becomes very clear to me that, well, the Fed has got a lot of power, but they don't have infinite power. Things get out of control. I mean, if they had infinite power, the overnight rates would never have spiked to 10%, even though they did it maybe for only like 20 minutes, it spiked. The fact is it spiked. And the fact is they don't have control. And then the other thing is, if you're sitting out there and you're buying NEO and all these stocks and Tesla, and you're doing financials out into you're doing financials out to 2030, and you're saying, well, based on what it's going to be in 2030, okay, fine. But you got to understand that things can change rapidly between now and then. And they can change to the point where, look, that stock gets cut in half or even to 1/10. You can lose 90% of that stock. And this is what, always happens. This is what really always happens. People look at it and say, well, they look back and they back fit, or they look back in time and say, well, I would have just held on to this. No, you wouldn't. No, after you get your butt kicked, and if you got margin on top of it, you wouldn't held on to that stock. You wouldn't have bought the dip. Are you kidding me? You'd be getting margin calls. You'd be like, oh my gosh, I'm going to lose my house the way this is going. And then, so what are you thinking? You're thinking that the Fed magically can solve all these problems. And what if the Fed says, hey, look, and they're not going to say anything. Remember, that's what the Fed does. It's not that they say that, oh, this is okay, we're going to allow this to happen. They never say they're going to allow anything to happen. They just don't say anything. And so we have a generation right now, and it's millennial generation, where you guys are lost. You guys don't understand. You guys have this mysterious thing that you think that the Fed is in control. And then on the other hand, you think that like there's all these big whales and stuff that can push GameStop up to $100,000 a share and Tesla up to $100,000 a share, whatever. And you guys watch Cathie Wood, who's just, she's just a Jim Cramer. She's like, she's like, look, she just keep buy until the point where she has enough redemptions where she's like, oh, I got to sell. And everyone watches her and watches all these other people, but you know what? There's the real world. If people pull even a little bit of money out of her funds, she doesn't have a choice. She's going to sell the crap out of crypto. She's going to sell the crap out of Tesla if people pull money. And that will happen. And it does happen, and it always happens. So there's several things going on, but the big one is like, why this fascination with believing the Fed? Of course you listen to what the Fed says, and of course you try to understand it, but you gotta, history tells you this. Like, do you really believe the Fed in 2000 thought, oh, it was great for the stock market to go down 50%, the NASDAQ to go down 60, 70, 80%? No, they tried to stop it, but they couldn't stop it from happening. The financial crisis, do you think they wanted to let all that happen? No, but they couldn't stop it. They couldn't stop it. No, I know the whole thing, Bear Stearns and Lehman, and they let this go and that go, but they couldn't really stop it. You know, at a certain point, yeah, maybe they misjudged whatever, but do you think like if things go, you know, you got to understand, like back in March of last year when they were closing down the economy, they pulled out all the stops. They went to the lower bound of everything that they could do. They're at zero, right? They're at zero. They're doing QE right now. They're buying bonds, buying stuff left and right. And they have this massive amount of you know, balance sheet they're trying to manage, and they're trying to do all this stuff. I mean, you're sitting there, they're managing trillions of dollars of securities, and do you think that it's not possible that it'll go wrong? Do you think that they can just magically fix everything? And the answer is, when you've been around a while, and you know, I don't mean to pick on the millennials, but I do. It's like, you don't understand until you've been there. Like, remember back in the financial crisis, Fannie and Freddie like went bankrupt. They basically had to get delisted, the whole thing. I remember I had puts on them, and they went from $1 to $6 on my puts. I'm like, woohoo. And it was coming. Do you think if they could have stopped it, they would have? They couldn't stop it. And they had to basically, in fact, take them all over and bail them out, right? And the stocks, they were publicly traded stocks for Fannie and Freddie. You could buy it like Tesla. So that's really the big picture for today, is when you're listening to the Fed, you know, from my experience, there's always a point, there's always the possibility that they do lose control. And all I can say is you're a chump if you think that that's not the case, because time has proven this before. It's happened before, and it will always happen again. You know, history, what do they say? History doesn't repeat, but it tends to rhyme. So now we're going to go to our charts, and we're going to look at some charts here. And then, so let's look at this guy. So what I want to do is I just want to look at, let's see, do I have the SPY? Let's look at just the SPY ETF. This is on the weekly, so we're trying to keep the big picture. So the big picture is like nothing going on. Everything's fine. We could go to the daily 6-month chart. It was fine. It's basically an up day. You know, what I would say, though, is we're kind of near the high, right? So we're kind of like, you know, we popped out to all-time highs. I guess the question is, are we kind of getting into a channel, to the top of the channel? Let's try to see. I mean, these probably the channels, you know, you're kind of hacking at it. You can't, you know, I mean, I'm kind of saying, oh, it's kind of a channel, and it kind of is, but, you know, you kind of went below the channel there. So, you know, that's somewhat valid or invalid, depends on your view. And so here you can see, when you include that point there, that, well, we're not at the top of the channel, and yeah, we're not. But then if you kind of just say, well, where was it touching it all the time? And you could kind of say, well, we're at sort of the top of that channel, right? So you have these excursions below and above a channel where you kind of repeatedly, you're hitting it and you're riding the top of the channel and you don't seem to go above it very rarely. So that's kind of where we are. So no big deal on the SPY. And then the thing is on the rates today. So 10-year is continuing to do its deal. So basically here's like a weekly chart and you see that the rates are continuing to rise. You know, it's continuing to rise and it's pushing into this resistance zone, but it is making progress in it. You know, it really is making progress into it. So, you know, the implication there is that, well, trend is your friend, right? People say that, and that's true. You know, that is one of the things that you lose the most money trading is when you're sitting there and you're trying to pick a top or a bottom. What are you doing? You're ignoring the trend is your friend. And this is the Van Meter guy right now. So the Fed's going to come in and have to hammer this down, or the dealers are short and they're going to have to cover. And all that may be 100% true, but it hasn't happened yet. I mean, it could happen, but that's all speculation. This is what we have. This is the fact of what we have. For going back to August of last year, we have this uptrend that's accelerating, right? So, you know, you can trade from fundamentals where there's a lot of opinions, or you can try to deal with facts. This is a fact. So you can pick which one you want to deal with. Yeah, because today, you know, the rates had you know, it had gapped up rates on the 10-year and, you know, traded pretty high and almost got to 1.7, but then it kind of calmed down. So, you know, it's kind of interesting because, you know, the Fed, yeah, I mean, the Fed kind of knocked it down a little bit. That's fine, I guess. And then let's look at another thing. Let's look at the dollar here. Let's see, I think I had this one. Let's use this comparative. Yeah, here's the dollar. So look, the dollar is interesting. So I'm on a weekly chart here. You know, dollar's kind of down, but it's trying to find its way up. And look at it, it's sort of hitting into this falling moving average, and it's kind of struggling to get above that. And so let's see, you can kind of see it. So you can see like in the very short term, you have like the 21 crossing the 50. So it's trying to create an uptrend, but it is kind of hitting resistance as to this longer term 200-day moving average. It kind of got stopped before that. So it's kind of finding some resistance there. So that's the dollar. And then, yeah, and then to Tesla, let's look at Tesla here. So big picture on Tesla is, hey, you know, I mean, it looks still uptrend intact, all that. So, you know, this is one of those things where it's like, okay, I get it. Like if you want to buy the dip, but like you need to buy the dip on the weekly chart, right? Because like if you're a long-term person and you're doing financials out to 2030, you should be looking kind of at a weekly chart and look at the daily to make strategic moves to buy more. And then, you know, I can see that you would buy more, right? And so, but here we are in the short term. What you have to deal with is you have the 21 crossing the 50, your downtrend in the short term. You had kind of, today was a very bullish day for it, because look at how it reversed and closed above the 21-day. So now you have this hump. If it can get above this high, call it 723, call the high here 713, and the high here 717. If you can get like above 718, 720 especially, then it's like, then it has a real chance of reversing there. So like in the short term, so the thing is, so once again, here would be like, this is not financial advice. This is kind of my thing is like, if you were looking at it, you know, there's people out there that are like, oh, buy the dip. Oh, buy the dip, buy the dip. They're buying the dip 5 times in a couple of weeks. And it's like, you don't have the resources to buy 5 times a couple. What, you're going to have 100% of your stock in this thing? You're in deep poo-poo. So you have to kind of be strategic. You have to kind of make your decision and buy a small amount or whatever you're going to do, you know, once or twice, maybe, you know, so that's kind of interesting there. And then just looking at another one of these high betas, NEO is like, once again, in the long term, yeah, kind of similar thing. I mean, it is, you know, it is big pullbacks. It's like almost 40-50% correction there, but still it's above that long-term weekly moving average. So I get that, but the same thing here, you know, you can't be like, oh, the dip, buy the dip. And you have like 2 solid weeks of mostly down data that you're buying the dip on. That's how you get yourself killed. You know, if you're on the long-term chart, then you got to admit you're on the long-term chart and sure, take the opportunity, but you got to just pick a point or 2 points with a small amount, whatever it is, if you had a position and you have a position size of X, and if you were doing something to kind of swing part of it and take profits, with 20% of it or something like that, or whatever your percentage is, when you come into these corrections, so somewhere maybe you were just like, oh, I take some off when it's like whatever at some condition, okay, fine, with 20% off, and then you buy it. Well, you can't keep buying in to make your position grow. It's just kind of position creep. So you just have to be careful with that. So I think that's kind of it. I think I was looking at this chart, and we have in the gold, the dollar. So the dollar, declining, but it's trying to get stronger here. We'll see if it looks like I was saying on the other chart, sort of hit some resistance there. This purple dots are the SPY, so just kind of straight up. And then the 10-year yields just going up. So that is what that is. I think the only other, let's write consumer staples, XLP. So this is the one that I was sort of leaning towards if rates get higher. So I'm kind of thinking of this one that maybe this will lead to outperformance instead of consumer discretionary. So right now for this week, it's just a big fat doji. So it's a little weak, I would say. And then XLY's got a bunch of Tesla in it. So Tesla was pretty strong today. So of course, it's got something like 20% Tesla. Check yourself. So Tesla bounce back. So I think that, so I think that's kind of it for this one. So in the big picture, again, it's like, things are fine. Really, things are fine. So it's just, if you here we're coming up towards, we'll get into the end of the week in a couple days. And if you're looking at it and you're having really heavy swings, then, need to kind of consider what you're doing, because if you're, the market is up a couple percent this week or something like that. I guess the concept, the concept is when you're doing a lot of trading and aggressive stuff, high beta stuff, and these type of stocks, is you have to understand the drawdown, and it kind of stinks, right? Because you honestly like to think you can time it right, and you can, catch the moves, and you can catch them right, but it's difficult, and you just have to get a positive number of wins, like even as little as 51% winners to 49% losers, but you have the money management to cut your losses on the earlier side, and your winners, you're able to ride them a little bit longer. But the net thing is that, I look at, like, especially the Kev dude, now I know he's just watching a lot of stocks, but looking at some of the lists, he's got a lot of stocks. Like, you're sort of just like, it's sort of that, it's sort of that, you don't want to admit it, but in a way you sort of have your own little version of the S&P 500. He might have 50 stocks or something holding across his different portfolios. So what is your net thing? You kind of have this, and then the reality is you have like a NASDAQ that's even more high beta than the NASDAQ itself. So what you have is you have a portfolio that's like, even though you're trading every day, so not only that, you're kind of burning up fees and losses and wins. You say you have no fees, you do, but and then on top of that, that's the other thing. So, you really kind of have your own little ETF there. And the problem is, if you have your winners, and you have your losers, your losers are taking away from your winners. So it's almost like a losing proposition to have that many stocks. That's what it comes down to. Because even just to trade that many stocks every day is very difficult to keep a handle on. They all become your long-term conviction stocks because you can't deal with monitoring them all. So so be careful out there. So we had the Fed. So I would, not financial advice, not a prediction, but I think the Fed meeting was probably, one of the biggest points of uncertainty right now. So I think that, that probably, like, the market I would suspect, is a little bit relieved. If Chairman Powell had messed up the a question and answer session that could have caused things to go blah, 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 but that didn't happen. So so the stress for the week in terms of like panic probably is resolved, except, your rates are high, so there's certainly no reason that you wouldn't be surprised you're over 1.7% sometime this week, because they just keep going up. They keep trickling up, they come down, go up. So this trend is very strong and intact. This ADX is funny. You can use this ADX indicator, and this thing's at 60. It's a very strong stock. So going back to guys, some of these guys had these trading strategies and from back in the 80s, and they use the ADX, and this is kind of like a strength indicator. It's kind of like, because I think the ADX, and you can check it yourself, but I think it has to do with like how the stock is closing. So it's relative. It's like, well, is the stock closing in the upper 25% of its range, kind of a deal, versus the lower, and that kind of predicts what the ADX is. And so right now, this is very strong trend. And the strategy that they had, right? So the strategies that they were using in the 80s, these guys were using, like, look, you'd have a 3-day pullback, boom, go along at the high, boom, boom. And they were, able to make money on it because the trend is so strong. And so that's something else to kind of keep in mind. This trend is really strong. So even if the Fed comes in, like, it's very difficult to break that trend. Like, you can go in there, you can put days, you can knock this thing down to 1.4% in a couple days, and the trend is still like, okay, and then it will kind of flatten out, right? I mean, of course you can bring it all the way down, but the thing is, it's going to take time to dissipate all this energy. And so you have different indicators here. See, what's funny is, because, like, a lot of people talk about RSI, but RSI is it's spent all this time, a lot of time, just in overbought, right? Above 70 or overbought. But yet there's still buy opportunities here, right? Because of the strong ADX. But of course, it's just a different strategy. This would be an aggressive strategy where you're up 5%, you're selling half, or whatever the thing is. So, the interest rates is the negative for the market right now, because that is still sitting there and it's still lingering. The Fed didn't convince the bond market to sell this way down. They kind of fought it to a battle, to a standstill for today. So that is it for this one. I don't know if people are, you believe the Fed, believe they're omnipotent. I don't know if that's what it is. But to me, they're not. And the reason is because I've lived through the crash. The first crash was the 2000 tech crash. That's a long time ago. I mean, I don't know if Kev was even born in 2000. All right, that's it for this one. Talk to you later. Bye.